What is a bond? A bond is an investment instrument that represents a loan made by an investor to a borrower. For example, suppose there's a company called Everything Industrial and they need to finance the construction of a new factory. Instead of obtaining the money from a bank, Everything Industrial decides to raise money by selling $1 million worth of bonds to investors. Under the terms of the bond, Everything Industrial promises to pay its bondholders 4% interest per year for 10 years with interest paid semi-annually. Each bond has a face value of $1,000. Said another way, it costs $1,000 to purchase one bond. Everything Industrial intends to sell 1,000 bonds to reach their goal of raising $1 million for the new factory. 1,000 bonds at $1,000 a piece equals your $1 million. You do your research on Everything Industrial and look at the financial rating of the bonds and the company's track record of paying back their bondholders, and you decide you would like to buy some of these bonds when they're issued. You buy 5 bonds for an investment of $5,000, and twice a year you receive an interest payment or coupon payment of $100, representing your 4% interest per year promised to you as the bondholder. At the end of the 10 years, when the bond reaches maturity, Everything Industrial returns your $5,000 deposit to you. In short, during that 10-year period, you collected $200 a year in interest for a total of $2,000, and at the end of the 10-year term, you received back your original loan of $5,000. This bond was a good deal for both the investor and Everything Industrial. As the investor, you received regular coupon payments, income for 10 years with the return of your original investment. And Everything Industrial were able to build their much needed factory. Bonds are often viewed as a safer and more predictable investment instrument than stocks for several reasons. Bonds are often issued with a guaranteed coupon or interest rate, provide regular income payments along with the returns of your principal. Stocks don't come with any guarantees of your principal or principal protection. Of course, bonds are not without risk. One risk is that the issuer, in our case Everything Industrial, could default on their promise to pay back the loan, and this is called default risk. Generally, bonds with higher risk come with higher coupon or interest rates. The investor needs to get a little more for the risk they are taking. Often government bonds are considered the safest type of bonds, while bonds issued by corporations are considered a little more risky because there is a higher likelihood that the corporation goes bankrupt and defaults on the bond. This is why it's important to do your research when it comes to credit ratings of different bonds. Credit ratings are given by third-party companies, so before you decide which bonds to invest in, always make sure to do your homework. The second kind of risk is interest rate risk. And suppose you buy a bond that's paying a coupon rate of 2%, and all of a sudden other investors can go out and buy a bond that's paying 4%. No one's going to be coming to you to buy your bond that's paying 2% if they can go out and get one at 4%. So if you're in a position where you need to sell your bond, you're going to have to discount the price of your bond in order to compete with the other bonds that are paying a coupon rate or interest of 4%, which may mean that you end up selling your bond for less than what you originally invested. This is especially relevant in today's market where we're experiencing rising interest rates. I would encourage you to watch our upcoming video on investing in a rising interest rate environment, how rising interest rates can ruin your investments. Bonds can be a great investment instrument and an integral part of a well-diversified investment plan. Bonds offer the opportunity to create steady income and provide principal protection, but it's important to do your homework first. And the question of today is, do you currently own any bonds in your portfolio? And if so, what's your strategy for dealing with a rising interest rate environment? Thank you.